Good evening, everyone, and welcome to the second episode of the Property Show Live. I'm Sabir Khan, broker of record at Dream Valley Realty. Thank you for joining us tonight. Whether you're a homeowner or a real estate investor planning to buy your first home or simply interested in learning more about real estate, we're glad that you're here. Today's topic is real estate tax strategies every homeowner and investor should know. Understanding how taxes work in real estate can help you save money, avoid costly mistakes, and make smarter financial decisions. I'm very pleased to welcome our special guest, Mr. Niloy Saha. He's a CPA. Niloy is a chartered professional accountant with extensive experience helping homeowners, investors, and business owners navigating complex tax matters and develop effective tax strategies. Let me bring Niloy to the stage. Hi, Nilada, how are you?
I'm fine, thank you. Thank you, sir.
Thank you for joining us tonight, and it is a pleasure to have you on the show. And to begin with, before you dive into the actual discussion, could you please introduce yourself for the viewers and tell our viewers a little about your background and how you became involved in real estate taxation?
Okay. First of all, I must thank you for inviting me and this opportunity. And I also want to thank our audience. And I hope they might get some insight from our discussion today. I am actually by profession a chartered professional accountant in Canada. I came into this industry since I migrated. So I was little involved in the real estate in the beginning. Then I got my appraiser designation. So I'm also a member of the Appraiser Institute of Canada. And then I became a chartered professional accountant later. So my main focus of the business is the real estate professionals, investors, of course, other business thing. Because I am also very close to the industry for the other profession, like I'm a residential appraiser. So I love to deal with this section is better my specialty, I believe.
Thank you. Our whole idea is to inform the first-time home buyers plus other professionals to learn through the process. And obviously, we know there's a lot of complications we face during the practical life. So we want to make sure as much information we can provide to our first-time home buyers, investors, even our agents, our other general people. I think that'll be helpful for their total home real estate journey, basically. So recently, I see there's a few tax law changes impacted real estate. And how do you see this? And how do you want to, some recent changes that impacted real estate, which way and how is it impacting the first-time home buyers? And our agents should be informed about that too. If you can explain about that a little bit for us.
Yeah, that's a very good question. But first of all, things I have to have a disclaimer actually. So this information show is strictly for the information purposes. And if you need to take any actions or something, please talk to your accounting professionals or tax professionals, and they should have the proper due diligence, everything. So this show or what I'm talking right now is strictly for the information purpose. Anyway, so especially recently something related to the real estate are big changes are happening. So as we know all that there is a capital gain exemption, especially for the investment property. So it was before 50% inclusion. Let me clear it up for the audience. Let's say you bought a property for $1 million and you sold it for $2 million later on, right? I'm just putting all the expenses in the side right now, so make it simple. So we have a capital gain of $1 million. So the 50% of the $1 million used to add to the income is called 50% inclusion. So there are some misconception about the 50% tax. It's not a tax. It is a 50% inclusion, and then they're going to tax on the tax rate of the person. Now that's changed. Last time it was from 50% to the 66.7% inclusion rate, but fortunately, previous government funded it, and our current prime minister came and he just canceled it. So we go back to the square one again. So it's still now 50% inclusion rate, which is good for the future. And the second thing is the big talk. Actually, the realtor and the investor, they can talk the flipping the properties. So there are a lot of things people are buying properties and keeping for some time and sell it and getting the profit out of it or loss out of it. That's a different discussion. You have to be very careful nowadays. For the CRA are very, very notorious right now. They open up a whole bunch of army to find these things. How this is going to work? If this property doesn't belong to you for less than 365 days, definitely this is a inventory or regular business. Discussion closed. Now, if you have the property more than 365 days, but there is a law called intended use. So what was the intention of the property holding? So capital gain tax was the intention to earn the capital gain, and then they're going to give you the benefit. But when it has become a practice that you are buying a property and 1.5 years later you sell the property, you buy another one and another one, and people start charging as a capital gain exemption. I have a practical experience that the CRA come back later and they going to say, no, all the property are not your capital gain. This is your business. So before you do some sort of decision as a flipping, please talk to your own accountant, because we cannot discuss every situation right now here. It is a very long discussion and every case is separate, right? So just for information purpose, the flipping the property, one or two, and the real situation might be CRA going to let you go. But if it is your nature of business, every year you are doing these things, so then prepare yourself that it's going to be a tax on the full income like a business. Second thing is that we all know the foreign buyers ban extended until January 1st, 2027, which is not good for our friends, fellow realtors, something. And top of that, battery on the ice on the cake. The Toronto at 10% surcharge, so it become total 35%, which is also extended. BC, I don't know to talk about it because it's nothing to do. Our people not going to listening from the BC. I don't think so. This is a different market. There is another change is the lifetime capital gain exemption that increased to 1,275,000 dollar for this year. It increased every year. So what does that mean? That means, okay, first thing again, don't confuse this one with your home capital gain or rental property capital gain. This is called qualified small business. So if you have a corporation and the corporation fit in the qualified small business corporation, which is an active business, so whatever the capital gain you are earning in the whole lifetime, that means $1,275,000 capital gain, you're going to get it tax exempted. This is a very big tax strategy, tax planning can happen, and you need a real professional service for this one. For example, if you have a corporation and the corporation fit in the QSBC, I say QSBC, Qualified Small Business Corporation, there are some conditions to fully, like it's an active business, not just holding the property. Let's say you have a 4 shareholder in the company. Now you do the math. You have a $6 million capital gain exemption. Take the $6 million home without paying taxes. That is the thing, good thing about the tax strategy and tax plan ahead of time. Design your business in future. Then there is some changes in the trust reporting rules. I think trust reporting rules is basically when you create a trust, that there are some internal rule changes. That is a very complicated, and you really need a good accountant who handle the trust. I'm sorry to say, not every accountant can handle the trust. It's a specialization, and they needs a long experience and the designation. And all we know, the mortgage rules is nothing to say here, because as long as a realtor, you know that mortgage change from 25 years, 25 years to 30 years amortization, all these things happening. So those are basic changes, and there are some internal changes in the tax that's not going to affect that much. We're going to talk about later. That's all. So you have another question? Thank you.
No, thank you. In the meantime, I'll ask the viewers, if you feel that this session may help other people, please do share this on your Facebook profile or Instagram, so other people can take get the benefit out of this as well. We want to make sure that everybody gets as much information as possible. So based on connect to your first question, so I understand that there are a lot of implications affecting the market and affecting personals and homeowners and everything. But what are the tax advantages that come with the home ownership?
So this, yeah.
If the homeowner owns a rental property, my question is related to rental property. If they own a rental property, what are the tax advantages for them?
Okay.
Tax advantages.
It's a very good question too. When you have a rental property, so let's say you have a house and you are living on the upstairs and you are renting the basement. I'm just make it simple. Or you have the full rental property, you are not living in the house. Doesn't matter that way. So whatever the interest, other expenses you are charging for the house, you can proportionally claim that money against your rental income. And so that let's say you have a $40,000 mortgage interest, but you are renting out half of your house, so you can claim $20,000 against your rental income. So it can lower your income tax. It's very, very good way. Plus same way property tax and all the other maintenance and everything. And now if you have a repair of the house, it goes same way. So proportion, but again, proportionate way. The portion of the house you are renting out, if you are living in the house, so let's say you are living 70% of the house and you are renting 30% of the house. So all the expenses are 30% tax deduction from the income. There is another way some people can do, that's called depreciation of the property. I'm not very fan of this one. The reason is here, when you have a big capital expenditure against the house, so you can still claim the capital depreciation, like in normal language called depreciation. We say in our term CCA, capital cost allowance, right? There is a fireback in the CCA. Let's say if you claim the CCA, for example, you have let's say I'm putting a number, roof renovation, $50,000, or big renovation, which is not a maintenance. So then you can capitalize that one and you can claim the depreciation against the income. The problem is here, if you claim the depreciation right now, but when you're going to sell the property, it's going to be recaptured. It's going to come back again. So to do this CCA, please talk to your, like, whoever you're taking care of your accounts, finance. You should have a long discussion. Maybe the experienced realtor, they might help the clients. And now the CCA for the new build, like if I go with the same thing, so if you build a house and same thing happens again, so you are eligible to claim the depreciation if you are renting out. And another thing is here, the losses, let's say some reason now last 2 years or 3 years, interest rate was too high, rent was not making that much, and you are making loss, which is not what I'm talking right now, which is not good for the normal business. But let's say you have income of, I'm putting a number, $50,000 or $100,000 general income, but you carry a loss from the rental property of 10,000, 20,000, 30,000. That's going to actually reduce your income. So income going to be reduced by your loss. And that's the main thing. But one thing I should mention here, I know you might ask you later, but it came to my brain. What is the difference between the investment or renovation and the capital investment? Okay. So when somebody spends some money in the house to renovate it or remodel it, whatever it is, the CRA wants to differentiate. Is it a short-lived renovation? Like, for example, you're maintaining a broken door, broken glass, blah, 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 XYZ, fine. Now you are changing the roof, or you are extending the basement, or doing the basement renovation. So big number of money. That benefit can be extended for a longer period of time. So that time CRA not going to allow you to charge the whole expenses as a current year expenses as a renovation. Rather than they're going to say, no, this is your capital expenses. You're going to amortize every year. Like we talked about the CCA before, right? So that's also a discretionary power of the CRA. So what they're going to decide it. But every accountant who have an experience with the real estate field, they can decide and guide their client what should take the action?
Now, the question, again, this question actually, so viewer can know about this. Sometimes people get confused about what expenses are actually allowed under for the tax claiming. For example, when you have as you said, like 70% you're living in the house and 30% you're renting out. Let's say I do some work in my kitchen upstairs, but it is part of the 70%. Can I 30% claim to the whole expenses as part of the expense? And on top of that, sometimes people get confused which portion of the mortgage can we claim. I know it's the interest, but is there anything else can be claimed on that?
It's interesting. So it's gonna very difficult to get answer of this one. But look at this way. Let's say the house is, I'm just putting a different way, 70-30 ratio. Okay, 70% owner occupied, 30% rental for a principal occupied house. If you have a full house rental, then straight cut, nothing wrong with it. In that case, all the expenses like your interest, insurance, property tax, repairs, maintenance, if you have a real estate commission, right? Let's say you are leased and you pay commission $2,000, $3,000 to the realtor, right? Those expenses go in the schedule called S776. That 776, there is a clearly mentioned how many portion you occupied, how many portion rental. Let's say I'm going to write it down that time. Okay, 1, 2, 3 Main Street, Sabbir Ahmed, rental income, let's say $30,000, right? And then all the expenses, we're going to put it there: property tax, maintenance, insurance, utilities, real estate commission, security bill, blah, blah, blah. And 30% going to be rental. So all these expenses out of $30,000, $10,000 going to be allowed as an expenses. So this $10,000 go back to your income, reduce your income to by the $10,000. That's the normal procedure.
Okay. No, thank you, Dad. I think that clarified a lot of confusion. And we're going to go to the next question that we have is, what are the common tax deductions that as real estate agents we often overlook? Most common that you have seen that agents does that mistake.
Okay. First thing, agent is a businessman. Okay. So they can claim all the legitimate business. And first thing first, in CRA or income tax purpose is the definition in the law. Because I'm talking about the definition of the book. Any expenses which is required to earn the income, that is deductible. Now, the question becomes, let's say common expenses for the realtor, we are entertaining our client sometime. If you throw a party to generate a business, that is deductible. But if you take your wife to the dinner or friends or family, that's not deductible. But yes, you can ask me a question, how can you differentiate? That is CRA's audit authority, they can do it. But if that in expenses, now go by the step by step. So all the home office expenses are deductible. That means the portion of the house he is using as a home office. Now back to the rental side again. That math we did it proportionately. Same thing happened here. Let's say, but be careful. Don't say that I'm using the 30% my home office as a realtor. So we faced so many audit by the CRA in past that they say, actually how much space I need for the home office. Let's say 100 square feet, 50 square feet to put a desk and something, because client not coming to your home. So CRA knows it, everything, right? So let's say the house is 3,000 square feet and you are using only 100 square feet or 200 square feet. That's called home office. So all the expenses proportionately of that part, they can claim as a home office easily. There are vehicle expenses, of course, gas, maintenance, everything. But there is a catch. It's very painful for the realtor or somebody. If the CRA audits you, first thing they're going to send you a letter, say, send me the driving law. How can you prove that the whole 30,000 or 40,000 kilometers you drove the whole year is not for your vacation? You took the family to the USA or somewhere else. So CRA wants to see the logbook. Okay, from 1 to 3 Main Street, I took my client to this one, from this one to this one, from this one to this one. I know it is too much, but there is a apps in the market, but don't ask me the app's name right now. It's out of my brain right now. you can add it in your phone, and you can just click, click, click. So they track the driving kilometer, and that's gonna save you a vehicle log that can give you all the okay. Now there is a one big discussion in the market right now: the commission rebate. Yes, you can use this commission rebate as an expenses, but after certain condition. For example, if you pay, I'm just putting a number, $10,000 from your pocket, and shake hands and say, oh, thank you very much for your opportunity, here is your money. So CRA wants to know these expenses is legitimate and paid to somebody, so that CRA can go back to that guy and grab the income tax on that money. So that's whole thing the accountant has to design the whole process, save some money. Like recently I am handling some audits for these issues, and that's a really mess. Meals and entertainment, I already spoke about it. All the advertisement, everybody, Google marketing, advertisement, blah blah blah, everything is there. If you have an assistant, so you can claim the assistant expenses, but there is a catch. If you have an assistant, the CRA not going to allow without any T slip. Either way, you have to give him a T4 or T4A. Because if you give him a salary to anybody, let's say $20,000, and you're telling CRA that, hey, I paid Mr. David for assisting me and $20,000, no. So team assistant is very good payment. They can claim it, but they have to pay the T slip. Like, there is one good thing, end of the year, most realtors forget it. So there is a called gift item, end of the year. You can gift certificate or gift card, you can give your client, again, to promote the business, but you have to have the receipt to expense, and you can give them the card, give expenses. Even the employee, you can expenses. So this is a and brokerage fee, desk fee, consultant fee, accounting fee, everything you need. Plus self-study, professional development, continuing development. If a realtor spend money for your development, study development, professional development, but that has to be related. It's not like, oh, you're a realtor, but you study medicine or what is called dancing or music. No. So it has to be.
That was very clear. Few questions came out of the questions again, though. In the meantime, viewers, if you have any questions, please feel free to make a comment here, and we'll try our best to have those answered by Nilada. And in the meantime, Nilada, I know you said about vehicle expenses regarding you have to keep a track of the mileage, kilometers through the app or something. But my question is, that a few years ago we have this PREC started for the realtors, which is a professional real estate corporation. Yep. So if you purchase or lease the vehicle under the PREC, what happens then? Because PREC is a totally separate entity than the person, right? It's a corporation. Can you claim 100% in that case?
Okay. The thing is here, you have to be reasonable, okay? Canadian income tax based on the reasonability. So let's say you have only one car in the family, and that car under PREC. How can you tell the CRA that you didn't go for grocery or shopping or medicine, something like this, right? Now, if you have a multiple car,
then you can
justify. Maybe. Okay. Again, it depends on the auditor opinion, but that time it is going to easy for us to tell them, hey, see the Mazda 1, like 3, 4, 5, whatever it is for my family car. I took this day, and my BMW is my business car, and I'm driving these things. That can be looks little bit reasonable. And look, this is a whole gray area. Okay, to protect the whole gray area, is better to have a tracker. But if you don't have an audited, nobody bothers. But if you audit it, trackers help you a lot.
I think my question is more like, when you have it under a corporation, so you still have to track every kilometer, although the payments and everything going through the corporation.
It sound too much. Some audience may understand I'm like little bit tough on it, but if the CRA bites you, they bites you strong.
I got it. Got it. Better to be careful than suffer later. Absolutely. Thank you, Dada. Appreciate the answers. Now, if we can talk about a little bit about as a principal residence, um, what are the exemptions they get, versus investors?
So, say, can you repeat the question again one more time? Sorry.
From the tax, for example, when you're doing like capital gains and all that, I think you already mentioned that if you live in the house for 365 days, then you are exempted from
No,
the
no, no, no.
capital.
Okay, that's confused.
Mhm.
That is 365 days is flipping the property.
For the flipping the property.
Okay, but flipping the property is the most dangerous practice right now going on. I have a client. He, our community guy, he bought 8 property 8 year. Every year, somebody told him you can do it. I told him the beginning. He known to me, right? They don't do it. Sierra gonna come back. 10 years later, Sierra come back and declared that that is his intention to avoid that taxation. They are claiming the whole tax. So, principal house or capital gain is a totally complicated part.
So you said that for the principal residence, this is the least concern as a capital gain. Absolutely,
Okay,
right?
let's say this way: when you are a really like principal residence, you are living in the house.
Correct.
You're not playing with the house, right?
Correct.
That's why CR Canada government giving you a benefit, so that a family you build a family, you live there, you are not playing with the game, right? It's fine.
Absolutely.
But in the principal house, there are a couple rules. Okay, if you want, I can discuss it, or maybe you can go to the other side. You want to listen?
It might be a long discussion but if anybody has any questions about it, please feel free to ask. But I think it is a complex matter, of course, capital gain, and it's more detail requires. But generally, what we understand from Nilada is basically, for an investor point of view, is one thing, and principal residence totally apart from everything else. But there's no capital gain for principal residence because they are actually living in that house. But thank you for answering that question. Now, if you can talk about a little bit about RSP down payments for the first-time home buyers, because from the tax point of view.
Yeah, that's a very interesting. Actually, really, this is a very good thing. So, especially our new generation or first-time home buyers, first immigrant. But again, I'm talking about first-time home buying. So there are two things actually, two benefits going on in the market right now: the first-time home savings account and the RRSP. So the first time FSA, first time home savings, home buyer savings account, the one you can save up to $40,000, $8,000 a year maximum, right? And that is you can use as your against your first time house down payment. And now top of that, if you have a RRSP and you didn't buy the house before, or you didn't sign any like co-signer or before or something with the parents or something, so you can borrow the money from your RRSP to top up the down payment, right? Now there is a two catcher here. When you are using first time home buyer savings account, that is totally tax free. So you are deducting the tax, and when you take the money out, you don't have to pay it back. But the RRSP money, when you are using it, so that means again, if the 2% are involved buying like husband, wife, boyfriend, girlfriend, whatever it is, so the both 2% can use their first time home savings account, and both the 2% can use the home buyer's loan plan. The home buyer's loan plan is the actually a loan. So you are taking loan out of your RRSP. You use the RRSP benefit when you actually bought the RRSP. That chapter locked. But CRA and Canadian government give you a benefit. Yes, you can take the money out of your RRSP, but the catch is there. You have to pay it back to your RRSP within an agreed time with the banks or CRA. Some banks give you a definitely 10 10 years, 12 years, 13 years. But there is a normal practice by the CRA. It's 15 years, you have to return it back. So what they do, let's say you took the money, $50,000, and those $50,000 divided by the 15 years, and they're going to ask you every year at the money as a deduction. That means you are repaying back to the RRSP. So you have to buy the RRSP for that money. If you don't, that money gonna be added to income, particularly that year, only for that portion, not the whole money. So you can use both money, and each person can be used. Homebuyer savings account and homebuyer's RRSP loan is $120,000. Is a lot of money.
That's a lot of money, and especially for the first-time home buyers, it's a really huge help.
And if the two person are applicant, like say husband and wife or boyfriend girlfriend, now it become $250,000 almost.
Wonderful. Well, thank you. I think you're covering a lot of. In one question, you cover actually multiple other questions for me, which is really helpful. Thank you so much for that. Next, I had a few questions written for you that I wanted to ask you when I come on the show. Basically, it is something that generally I get questioned from people, but I'd rather have that answer come from the professionals. So the next question I have is about family matter. There's many questions people, as we get older, we get worried that what happens to our home when we pass away, right? So what is the procedure in the CRA point of view to passing the real estate down to the families? And how we do it, and what's the best option for that?
It's a very, very interesting chapter for me. Now I need a lawyer beside me. For the 50% of the case here are with the lawyers. So
we had this answer actually last week, a few of the things, but I want to hear from the CRA point of view.
CRA point of view. So basically, let's say our client, Mr. David, owned 2, 3, 4, 5 properties. And he got 2 children, maybe multiple more. So basically, the principal house, as we talk already, that's it, exempted tax-free. No question about it. Fine. So we know everybody gonna go one day. So let's say these couples are married couple. So when the first person passed away, so the whole property roll over to the second person, legally married or common law partners.
Is a joint tenancy, basically, you're talking about joint tenancy.
No, joint tenancy is the legal side. I'm not going the legal side, I'm going the tax side. That's why I'm saying the lawyers gonna be side.
Correct.
So
correct.
Any lawyers listen to me, don't drag me there, okay? So the rollover is gonna be automatic rollover to the surviving spouse. Okay. Now the surviving spouse when passed away, then whole property gonna become a estate automatically as per the CRA law. So that time is a will, probate, all this system coming through. Okay. So will is a different purpose. Nothing wrong with it. Very good thing to have it, so that can reduce the probate fees, right? And we can have a trustee easily. If you don't have a will or probate or something, then court might appoint the trustee. That part is the legal side. So the trustee is the responsible to pay the taxes. How is the taxes? I'm finishing up quickly. It's a very big discussion. Let's say that passed away couple or single person, whatever it is, have a lot of investment. RRSP, stock, bond, real estate, XYZ. So everything goes at fair market value on his passed away date to the accounts. Now, the time he bought the property, let's say he bought a property for $1 million. At the time he passed away is now $2 million. So now become a capital gain of $1 million. This is the way they're going to accumulate everything. Plus, if they have a RRSP, if they have an investment, stock, bond, everything go to the buckets, and the accountant or the lawyer gonna calculate the capital gain amount. Now, the trustee is liable to pay the taxes first to the CRA, and upon satisfying by the CRA issue a clearance certificate. After receiving the clearance certificate, the trustee can distribute the property or asset as per the will or as per the family law, because Canadian family law is a very clean distribution laws there. The lawyer can explain better. they can distribute the money as per the agreement. Now, the question is here, if they don't have enough fund to pay the CRA, because now you have to think about it. When you are selling the property and you're calculating that capital gain tax, is a huge difference. I'm talking about maybe 30, 40, 50 years down the road. So most of the time, some people don't have the money. So the state needs to be sold. That can be avoided. There's the, if the asset stay as a non-incorporated style. Now think about the other way. Let's say a client, very like smart, working with a very good accountant, and never tried to save $100, $200 for the tax purposes. So go to the good accountant, did the tax planning or something like this. So they have the option to incorporate the investment, all these things, and put the every property or anything in the corporation, and the day it's called tax planning, right? So now the corporation own the property, so that when the person passed away, only his share can be taxed and valuation, not the whole structure going to be. It's very complicated, and it is you need a tax planning expert. So that's the main thing. That's why a lot of wealthy people are created a corporation and putting everything in corporation, section 85(1). They transfer the properties and they created the business through the corporation, maintain the asset, and distribute the percent. It's common ownership. I can make it complicated, and it takes 2-3 days discussion, but just that's the main thing. But one thing you have to be, just to information purpose, if you own the property already and you want to transfer to the corporation now, that might be little expensive, because you have to give the land transfer tax again. Right. So let's say I own a property and now I open up a corporation after talking to anybody, and the property goes from Nilay Shahar to the 123 ordinary incorporation. So the new owner going to go on to 3 Ontario corporation, right? So then we have to pay the land transfer tax again, plus the lawyer fees, all these things. So that might be a little expensive in the planning process, but depends upon the volume of the estate. So it depends upon the plan, but you need to talk to a real expert who knows the section 85(1) and restructuring the company.
Thank you, Dada. So in your opinion, what's the most tax efficient way to hold any real estate? Is it personally or corporation, or via a trust?
Okay, trust. Let me clarify that trust is not a corporation. Trust is something else. Okay, it is very complicated. And another dangerous thing is a trust. Every 21 years later, trust dissolve automatically.
Every 25 years.
21 years.
21 years. Okay.
Oh, so the purpose of the trust is something else, to protect the asset, distribute the beneficiary. If you have a kids under minor, so many things will happen. But excuse me. So basically, tax efficient way depends upon the size of the estate. Let's say if you have a 1 or 2 properties and you're talking about all these things, it might be expensive. But if you have a really handful of properties, so because you need a good accountant that time, you need a good tax accountant that time, right? So now it become again corporation, so you have to pay the corporation return, right? So those things. But holding a property in a corporation is a lot of benefit. You can pass this corporation generation by generation. Now we remember some wealthy families in Canada, they are holding that corporation, holding the business in a corporation, and they're passing the share, right? Now you remember I was talking about in the beginning that capital gain, lifetime capital exemption in the very beginning. Mm-hmm. If you own the real estate and if you can make the corporation as a QSBC, that part is very complicated again somehow. So each shareholder can exempt it as if today 1.275 million. Now think about this way. If you have 10 members in the corporation and you have a $30 million investment property and you have a capital gain tax of $20 million capital gain, 10 shareholder, you're talking about $22 million without paying taxes to the government legally. That's a big game you can do legally, lawfully, with the proper, talking to the proper tax accountant. I'm saying proper tax accountant.
So it all depends on the size of the real estate. That's very important.
Size of the investment.
Investment. I mean, yeah, definitely. No, thank you so much. That clarified a lot of confusions that sometimes people have. And when you talked about the corporation, another thing I want to know, how does it impact in the real estate partnership? How they tax differently?
Okay, partnership is not a corporation. Okay, the partnership, there is just technically this is something that you bought a property. Let's say you and me are partnership, and you bought a property. You bought a property or two property, three properties. So all the income are taxed under partnership calculation. They're not taxed at our hand. So the partnership distribute the amount to us. So partnership actually is, again, it depends upon everybody's situation different. Purpose of the partnership is different. It might easy to pull some capital right away or something like this, or corporation, because the corporation, if the corporation hold the property, they tax at their end, then they distribute. They might distribute, they may not might distribute. They can carry the loss, they can carry the profit, right? But the corporation are normal way, but it taxed at the partner's hand. Another thing, as you know, that at a personal level we pay highest taxes.
That's right. Yeah.
And the corporation we pay, depends on the province, but I'm putting a roughly 12.5% right now. Here and there. Every year that change. So let's say we have a corporation and we have a $10 million property. And let's say we have a $500,000 revenue, net profit. I'm just putting a number. So the corporation only pays up to $500,000, 12.5%. Now, same situation, the partnership makes $500,000. And you and me are the partners. So we got each technically $250,000 in our hand. Now we are going to pay 52 point some percent taxes. Now we do the math.
Right. High tax bracket, of course. Yeah.
Because at end, as a human end user, we are the paying highest taxes.
So for the corporation, is there a bracket like that? Is there a bracket? What is the maximum?
Up to $500,000. So we have a small business deduction.
Mm-hmm.
After the $500,000, it goes back to the tax rate.
So as far as Ontario, it's 12.5%.
No, yes, yeah.
As per Ontario, and after 500,000, how much it goes to? Just a rough idea.
It depends upon the industry. 38 to some industry, property. All these things are complicated. Okay, but somewhere is 38.
38%.
38%.
No, thank you so much. And now we're going to get into a little bit about new build, because recently, as you know, the Ontario government and federal government issued some new incentives for the first-time home buyers who are investing in the new build. So one of the questions actually I got from one of the client, he has a closing coming up very soon, rebuilt pre-construction, and he rented out the property during the occupancy period.
Yes.
So he rented out like a few months ago. He's collecting rent. In the meantime, because the rental property and the utility all been registered under his name, but his address showing as his primary home. So the builder decided not to give him the credit for the HST. Instead, they added to the HST. And what I understood is, I told him that we have a show, so we can ask that question. But if you can explain this a little bit in detail, so the viewers can know, and that I hope my client is online as well. He can watch that as well from your experience.
Oh, this is like not that complicated, because recently it happens to my own property too. Anyway, so first thing, the property has to be closed. So sometime, as a condo, if it is a condo, maybe occupancy 5, 6 months, 7 months, 1 year takes to the
Mhm.
close. So during that time, nothing gonna happen.
Mhm.
So after the condo closed, I'm talking about condo.
Mhm.
Freehold is a different situation, of course.
Mhm.
Uh, let's say freehold and condo both got closed, and it is a
Mhm.
rental property.
Mhm.
Now, if the property owned by purchaser, so as you know, the new law that they can waive the HST. So
Mhm.
let's put it in a side right now. This is not the question here. So they can claim the government CRA rebate, that is maximum $24,000 through the CRA website. So they need couple documents, not couple, 3, 4 documents, like purchase and sales agreement, fully executed, title documents, lease agreement, uh, because it has to be long-term lease, not a short-term lease. So
Correct. At least more than 30 days, right? Or 1 year.
it is a expected 1 year,
Mhm.
because normally when you sign the lease, it's normally 1 year.
1 year. Okay.
So now the step is they need to be, if they want they can do it by themselves, but it is might be complicated. But I suggest them talk to some accountant. They can ask for a HST number. If they don't have a HST number, they have to have an HST number for that purpose, because it's an HST claim. So the CRA love to issue a HST number. Even they can get it over the phone. They can just call the CRA, hey, I'm David, this purpose I need a HST number. They're going to give them over the phone right away. So then they can access to the CRA account. Now that part getting complicated. So that's why I suggest talk to his accountant or some good accountant, tax accountant. So they can claim the documents. Now it's very easy. Online version, they can claim this HST rebate through the CRA portal and submit the documents. It is not like before, it was so painful. We have to make the application, staple it, and mail them, and nobody knows in between documents lost. So once he submitted the application, the whole statement gonna show up. How much he gonna get the rebate? So basically, there is a simple math calculation built in the CRA account. So roughly around, because nowadays Toronto market is hard to get less than $300,000 property. So of course, more than $300,000
Right.
property.
But my question is, definitely they qualify, even the property is rental, they qualify to get that rebate. And obviously they have to go through the process, apply online and get the, but how, why a builder doesn't allow that from their side? Is there a particular
No,
reason why?
builder for their own risk factor.
I see. Okay.
Right. So let's say I'm not okay, I'm not saying to anybody, don't take it like as a granted. Somebody took the property and sell the property next day, what gonna happen?
Right. Right.
Right. So who gonna give the guarantee them? So that is their duty. When, like normal business, right, they're selling a property, they're supposed to collect the HST 30%. Like when you guys are selling a real estate commission, you have, it is your duty to collect the HST, then it is your duty to pay the CRA, right? So in between whatever the expenses, they're going to claim it. So HS, another reason, the builder spend a lot of money what he can claim the HST.
Right.
It's a couple $100 million investment, right? So they are buying all these properties, they are buying all these consultant, blah blah blah, right? So if they don't get the HST collected, how can they claim the HST credit,
So they
right?
keep it separate. If it's owner occupied, they put a
No, the
HSC
lawyer
rebate.
can lawyer can step in that time. They have to prove that they're gonna occupy. So that
So
before
lawyer
the
can
state,
fight that actually. Lawyer
yeah.
can
So
fight that. Yeah.
only lawyer can claim if it's the owner occupied. Now that's why normally when you talk to the lawyer, they ask you, are you going to be occupied it or not? So then you have to
Right.
give a like declaration, and then they're going to process it. So then they can reduce the discount. It's a lawyer's job. It's not something we can handle it.
So the bottom line is they will get it as long
They
as
will get
they're.
it. And nowadays, it's not that waiting long time. Once the deal is closed, you have the lease in hand, you submit the application. Depends upon 4, 5 weeks, 6 weeks. like I have a experience, it comes within 3 weeks.
Perfect. Thank
And
you.
automatically
And
deposited.
next, I want to ask, I hope we answered that question for that client and he got to watch and understand the whole fact how it works. And the next thing I want to explain, I want you to explain a little bit about the new HST policy for the new built home. If you can explain this for the viewers so they can understand a little more, because they're trying to, government is trying to attract more people to buy the new builds, and how exactly it's going to work. Do they get the refund, or is it after the closing refund, or they get adjusted, or is it a rebate? If you can explain it a little bit in short.
So basically, this HST rebate is the first-time home buyers. So if you are not a first-time home buyers, there is some confusion happening in the market right now. Some of our parents previously bought the house and they might need the co-signer, and the kids sign the co-signer. Story closed. So that kids is no longer first-time home buyer.
If they use them as a for to get the mortgage, of course.
Co-signer. Some of them might be. I'm not saying everybody. So let's say your case is clean. You never signed the somebody's co-signer, right? Then you can claim the HST exempted part. So again, the whole HST closing is done by the lawyer. Same thing. Let's say you bought a property for $500,000, right? If you look at the statement of adjustment, so they clearly mention taxed out amount, the lawyer says. So on top of that taxed amount, the builder charged the HST. Let's say if the property, let's say I am buying a house, condo for $540,000. I'm just putting a number. My taxed out amount is not 540. That is included the HST. So my taxed out amount is below that. So the lawyer on the closing, when making the final statement of adjustment, he gonna submit all the documents and the due diligence. I'm not going how they do it. That's not my job. They have to declare that this guy is tax exempted. So they're gonna pay the. If you look at that without the tax amount.
So the advertisement price they actually put in, that is including HST, of course. That's the
Including
way.
HST.
Yeah. So now it's going to be, based on if it's a first-time home buyer, if they qualify for it, it will be deducted from the price, basically. That's how they're going to pay the mortgage
Yes.
time.
Yes, but they can do the math. Actually, nowadays, what the builder is saying, that if they say I'm a first-time buyer, they're going to give them a rough idea. This is going to tax out price. You can calculate easily that, okay, if I'm buying a property for 500,000 for the general public, because of course they advertise for everybody, so that you can tax it out, tax the HST out, do some basic math, and you can get it. But it is only for the one time in a life.
Right. And definitely it's a huge saving for the first-time home buyers, huge saving, especially for the new build homes. And over the last few years, the new build home price like sky high, because the cost of like all the raw materials has been crazy last few years. So definitely that's been very helpful. On top of that, they actually giving discount on the development fees, which is also good. So that's going to bring down the property price for the new construction, basically.
But one thing our audience should know, that there is a limit of the buying a property. It doesn't mean then you can get the exemption for $5 million property.
That's right. Yeah, it's maximum 130,000. Right?
Maximum 130,000. That means 1 million.
$1 million. Yeah. And what happens? So anything if they purchase over that price range, they will still get at least 130,000 rebate, and rest they'll be paying tax, basically.
Exactly.
So let's say if it's $1.1 million house, so they'll be paying getting rebate 130,000, and they'll be paying taxes on $100,000.
So that time they're gonna calculate the based on 1.1 million deducted by the 130.
Divided by 130. That's right. Yeah. Perfect.
Again, okay.
Total price. Tax will be total price.
Yeah. But one thing we are still confused, is not cleared up by the CRA yet, because it's new happening right now. If that happens for $100,000, is there going to be any tax exemption or like rebate or not? We don't know yet.
Yeah, it's fairly new, so a lot of things are still implementing.
Yes. We are still waiting for the instruction. I think they are struggling with the situation right now.
Right. No, thank you very much for well explanation. We have a few minutes left. I just want to get into a little bit about the foreign ownership, foreign buyers. We all know that foreign buyer has been restricted for now. There's a bar on it until January 2027.
Yes.
We're really hoping that it's probably going to come off. But in the meantime, there is some buyers are exempted from the purchase, like employment, who has employment authorization work permit, students, and few other people, I think who has temporary residence in Canada. How does it impact them when they actually purchase those houses? If there's an NRST they have to pay at the moment, or how does it exactly work? If you can explain it short.
No, if the exempted, so everything gonna be normal. Okay, but I think actually they're gonna be the one topic I should raise my side from now. If some foreign owner already own the property, and now if they're selling the property, our realtor should know these things like property. There is a huge tax implication when they sold the property.
When as a foreign homeowner.
Or okay, that is a gray area. Let's say you are a Canadian citizen, but you are living in the USA. A lot of people right now, right? And so you're not a resident in Canada. When you are selling a property, it's called resident status. If you are not a resident of Canada, you might be in USA, you might be in Middle East or some reason, right? You're not an official resident in Canada, and you are selling the property. So the lawyer, that's why lawyer always asks the driving license, all these things, where is living. They want to prove the residency status. So if the seller is not a resident of Canada, so it doesn't matter you are a citizen or you are a foreign investor, you are not living in Canada, then it is a lawyer's duty to hold 25% of the sale price. That's very dangerous. You might not be close the property as a seller, nothing to do with the buyer.
So NRST, that's the non-resident sales tax, basically.
Non-resident. It's not, it's not tax. It's a whole withholding.
Withholding, okay.
Because the CRA wants to make sure if there is any capital gain, they can grab you. Just think about this way. You are living in Middle East and you sell the property, you took the money out of the country. How can the CRA get it?
Correct. So it doesn't impact the person under work permit, but they are resident here, so they don't have to pay that NRST.
Okay, that's a very good question. I have no clue about it because there's nothing written there. It's the lawyer's duty. They are the hook here. Luckily, we accountant don't know that clearly part about that detail. So they say non-resident. That's it. And they have a clear form that if the lawyer don't hold 25% of the sale price, that's very dangerous. Not a profit, sale price. So they cannot close the deal or they have to pay it from their account to the CRA.
Right.
Now, there is an option. So there is a clear-cut form. Might be you don't have a capital gain of $200,000 for a $1 million property. Might be. Maybe you have only $20,000 profit. So you have to apply by an accountant or yourself. There's a form. So explain them, I bought this property this much, this is the sale price, this is my real estate expenses. I have a profit of only, let's say, $20,000. Then CRA going to tell, fine, give me that 25% of this or 15% of this $20,000. Once they deposit the money, now it's much lower deposit, right? So CRA get the money, capital gain tax ahead of time. Again, the 50% inclusion plays here, right? Because my $20,000 profit is not a $20,000 profit, it's actually $10,000 profit. So profit, exactly. So it's much lower. But the tricky part is it takes 2 to 3 months to get the certificate.
Absolutely. Sorry, I have to stop you there right now, Dada. Sorry, our time is over. We don't have much more time. but it was a very well explained, and it was a wonderful presentation from your side. I highly appreciate your presence here today. And I want to thank our viewers for being patient and watching this show for us. And we'll be back again next week with another topic. In the meantime, for Nilay Saha, if you have any questions, feel free to reach out to us. We'll be happy to pass those questions to Mr. Saha, and he can answer those on a later date through an email or something. So I really appreciate your time. And for next show, if you have any questions, feel free to also contact us or send us a comment in our Facebook page. Please do follow our Facebook page and our YouTube channel so you can be notified when the new show comes up. So every Thursday, 7 to 8 p.m., we're here. And have a great night. And thank you very much for watching for tonight's show. See you next week. Thank you so much.